we're going to get going by just doing a little bit of introductions, reviewing everything that we're going to be covering. My intention with this, though, is to make this conversational, not one-sided. I'd like you to be able to chime in if you need clarification or didn't hear something clearly. Um, let's just think of it more as a group conversation. Um, and if we lose you at any point, yeah, just raise your hand about that too. So, you guys all basically know me, but a little bit more about me and my background within real estate. So I've been doing this since 2018, have done over 230 transactions since that time with 64 five-star reviews with Zillow. I have a couple special accreditations as well, which includes a negotiation expert and a buyer's representative. I myself have been a Chicagoland for 16 years, and within that time, I convinced my Texan wife to make her way up here, and we've had our two kids that are going to be 9 in a couple months, or in a month, that we've planted our roots here in Chicago. This is us we just went to New York a couple weeks ago. It was a great trip. It was fun. And in my own time, I like to do stuff on my own around the house, DIY repairs, learning how to take care of my house better and build things especially. And then I love going to live music here in Chicago, and there's plenty of it. Emma, over to you.
Good evening. So I'm Emma Butler. I am a residential mortgage lender, and I have been around for a very long time, doing all things mortgages since '05. So I've seen everything there is to see. Um, I'm top in the country for the last few years. So far, last year I did 38 million. Just numbers here. I've done a lot of loans, is what it's just saying. I'm originally from Ireland, so I moved here in 2003. I did not move here to be a mortgage lender. That wasn't on my mind. I don't even think I knew what a mortgage was. I just came here for a little bit of adventure, and I never went back. Well, I do go back. I just stay here. I live here. And I love what I do. That's why I've been in the business for so long. I love being active. A few photos here. I did the triathlon this year and last year. I love training for that. Keeps me busy. I love entertaining. This photo underneath me of the triathlon was a happy hour I did for a lot of clients that closed in the spring market. And then I love to travel. This is me and my sister and her son. That's back in Ireland. So I go home pretty frequently, probably twice a year. And then the bottom, those 3 people there, that's my team. We've got Amber, Jose, and Michelle. So they help us keep everything moving smoothly. So it's a little bit about me. I'm going to dive in a little bit into the mortgage side of things in a few slides to come.
Awesome. Thank you, Emma. So today's objectives is really just to provide information and clarity, get you guys excited about possibilities, especially when it comes to owning your own property, answering any questions that you might have, and then hopefully that you're leaving feeling more confident about buying a home. So getting right into it, one thing I want to start with here is just telling you a story about myself. I mean, I assume if you're here, you're at least curious about buying. But for the younger me, I totally didn't know why I should care about buying. It was actually Janelle, my wife, who was initially the one that was floating this idea before we bought. I personally, it hadn't really occurred to me. I was happy paying rent where we were. It felt predictable, it felt safe, and I didn't really see why I should go into this like big adult thing of buying property. And so if that sounds familiar to you, you know, maybe you've thought the same things or been in a similar position. And I do hope that going through this today, you'll get some clarity like clarity on the process, clarity on the benefits, and clarity of this potentially becoming a reality for you. So affording a home, coming from that mindset that I was in, I think it helps to start with what you know right now. And what you know right now is how much rent you're paying. So if you're paying $2,000 a month, this is a good place to be able to start. And what you can do is you can use a mortgage calculator to give you a better idea of what $2,000 a month would look like and how that would translate to the purchase price of a home. So this, I'll link it to you guys, but this actually goes to Emma's site, which she has her own mortgage calculator, um, which works really well. But that's one way of taking what you know right now and being able to understand what this could look like in your future. Another quick calculation that I like to share is um, take if you're single, your own yearly income, or if you're coupled, um, you would take both your yearly incomes and triple it, and that is like a really rough ballpark of what you could afford with a sales price. If that makes sense. Um, that's a great place to start. As far as a common question here is like, okay, so that's the mortgage, but what about there's all these other things. There's taxes, there's interest, there's insurance. So maybe what you don't realize is that when you're paying that monthly mortgage, you're covering all of those things. So you're paying toward the principal of it. You're also paying the interest and the taxes and the insurance, and that's all your mortgage. So there's nothing um, extra to that. And then, of course, like the next step, if you're really starting to think this through, is getting pre-approved.
Hey Keith, sorry to interrupt you.
Yeah,
Did you say like so the mortgage price, did you say that included taxes and insurance and stuff like that? You're not getting a separate tax kind of bill at the end of the year?
that's right. So, uh, yes. So what they'll do is, without getting too much in the weeds, you pay taxes for the year that's already passed, and then you're paying into an escrow account during the present time that will then pay it. That will then pay it when it comes due next year.
Oh, thank you for clarifying that. That makes a lot more sense.
Yes, it does. Thank you.
Thank you.
Yeah.
Sorry to segue,
Yeah,
but yeah, thank you.
And like, yeah, if you want to get even more granular about it, like some people choose to save that money on their own and not have the mortgage company, whoever has your loan, do it. But for the most part, it's usually what you're paying into, and then they pay that tax bill when it comes due. Cool.
Okay, that makes a lot more sense. I've seen mortgages, I guess, estimated payments that they're higher and lower, and I think it would make sense that one is including taxes and one's not.
Yeah.
So thank you.
Yep.
Keith, I have a question. I have a question for you.
Yeah.
What jumped into my mind way back 1999, with my original starter condo, they had this uh, item, this feature called mortgage insurance that they put in there. Is that calculated into, like these figures that you're looking at with the mortgage calculator?
Yep.
Or
Yeah.
where's that minimum amount of down payment either,
So Emma's going to talk about that a little bit
okay.
more in depth, but that's a really
Okay.
good question. Yes, if you're under 20%, then you'll have PMI, which is primary mortgage insurance, and we'll talk about that a little bit more in depth.
Okay.
Here coming up.
Mhm.
One other thing I'll add to this last bullet point is that I wouldn't say that you should wait until you just need to get your pre-approval before talking to a lender. It's good to start the conversation early so that, as you'll see as we talk a little bit more, Emma can be a great resource in advising on how to make you as strong on paper as possible before she's like getting a pre-approval ready for you. So just another thing to keep in mind with that. Thank you guys for the questions too. Okay, and then now I want to just talk about the process of when you're starting your search and then to when you own the home. Just quickly overviewing all of that. So the typical search timeline can vary greatly. You know, if you're very loosely looking and you're looking for something really specific, maybe it's going to be, I mean, it could be years. You know, it just depends. But if you're really searching in earnest, that typical timeline is usually 2 to 8 weeks long. That's just the average of what we found. And then once you land on the one that you really like, or want to see if it could work out for you, then what do you do? The next step is that I prepare a CMA, which stands for Comparable Market Analysis. So since you are just seeing a price tag and you have no idea what that means, with this comparable market analysis, it gives you a rundown of comparable properties in about a half-mile or 1 mile radius around the property and what they've been selling for recently. So then that way you have a better idea, you feel confident about whatever you're going to put in. And then with that, we decide on the price, the terms, any contingencies, and we submit an offer. I submit an offer on behalf of you. If there's any negotiating that needs to take place before we're coming to an agreement with the sellers, we'll do that together, and I'm talking with the listing agent about that. I think one thing that's helpful about Chicago right now is just understanding that it is still competitive in Chicago, namely because there's not enough properties for sale. So if you are looking in the next 6 months or a year, I don't know exactly what's going to be happening, but it's not crazy to think that multiple offers will still be expected just because of that low inventory. So we get through negotiations. We're great. We are now under contract. There's about 20 different names for this. So here's a couple: pending, contingent, in escrow. All these things are true. They all mean the same thing. Once that happens, the next steps take place pretty quickly. So you'll plan your home inspection, which will take place in the first week. And anything that comes up from that, we'll negotiate on repairs or any credits that comes up. And then the appraisal and underwriting begins, which is where Emma's team really comes to the forefront. And then once we are all good with that, there's the final walkthrough, usually the day of, and then the keys are in your hand. It's your property. So generally, from when this took place, the offer is accepted and you're under contract to closing day is generally about 30 days. So this is 2 to 8 weeks of searching, but then you're under contract, 30 days to closing. Is everybody clear on the timeline? Awesome. Okay, now the other part that I like to know is, what is this going to cost? Obviously, the down payment is something that's focused on a lot, but what else gray area costs are going to come out of my pocket? So I like to talk about it in terms of when money is leaving your wallet. When money is leaving your wallet. So the first time that any money leaves your wallet is once you've been under contract, that's stamped. Your contingent is when you submit earnest money. So this is your skin in the game money. It's dictated within the contract. It's no less than 1% of sales price. Okay, so it's $300,000 place. Expect it to be no less than $3,000, and this goes toward your closing costs, as it says here. So it's credited at closing costs. It's not an additional fee, but it is when you pay something. The second time that any money leaves your pocket is the home inspection. This is somebody that you are hiring as the buyer, and so it's important that they're objective and they report to you. So you'll pay a few $100s to them. So that's the second time, and then the third time is going to be the appraisal. The appraisal we can talk about more, but basically it's the bank assessing the property. You pay a few $100s to do that. Okay. So those are the time, and then no other money should be leaving, except maybe paying movers or whatever, until closing. And then that's when you're doing some other stuff that we'll be talking about. But those are the costs that happen. Okay, so once you're at closing, other than that down payment, what you should expect is generally 2 to 5% of the purchase price is going to go toward closing costs, which we'll talk about a little bit here, and I'll outline. The biggest thing with Cook County, if you're buying in Chicago, the next biggest expense other than your down payment is going to be transfer stamps. And what that is the city, you know, they're documenting it and they're getting their piece of the pie. And that's $7.50 per $1,000 of your sales price. So as an example of $400,000 property, then $3,000 is in transfer stamps. So that's not an insubstantial amount of money. That's usually the biggest amount other than your down payment. And then I always like to say it's good to have a little bit of cushion. You don't want to be completely left with nothing once you're moved into the place. So having a little bit of move-in expenses and some money budgeted for once you're into your new home. Any questions on this part of it?
So does it turn out that the buyer incurs most of the upfront costs as opposed to the seller?
I wouldn't say that, no. So some of these areas here, they are also having to do different kinds of processing fees and municipal areas. But I don't know exactly how it always splits. It will depend too, like as an example with cash transactions, um, the ratio changes a little bit on these types of fees. But the other thing you have to remember too is with sellers, even with current changes within the rules, they're still majority of the time paying for both the seller and the buyer's agent. So they have that large expense that they're paying for that the buyer's not.
And then Keith, most of the so in the city of Chicago, the buyers pay the majority of the stamp tax. In the sellers pay a little less, it's $3.50. But in the suburb areas, the sellers pay most of the stamp taxes and the buyers don't pay any. So in some areas, the sellers pay more than the buyers. It just depends.
Yep, gotcha. And we're not going to break down all of this, but this is an example of what that 2 to 5% includes. So this particular breakdown does show the home inspection fees, the appraisal, and then you can see down here, like transfer tax. That's what the stamp tax is. So all of that amounts to that. So I know that can get a little bit confusing, but if you plan on that 2 to 5% on top of whatever your down payment is, then you should be in good shape. Okay. So Emma and I are both going to talk a little bit about that discernment process then of deciding what makes sense about buying or renting and which position makes most sense for you. What I always tell people is if they really have no idea which way to go, an easy way of assessing is if you plan to spend 3 to 5 years in your current place in this city, then I think it's definitely worthwhile to consider buying. If it's going to be less than that, then it's probably just easier to rent. But 3 to 5 years is a good range for you to consider for that. Lifestyle flexibility versus stability. Emma and I have some friendly disagreement about this a little bit. And I totally see her point too, but you need to live somewhere. So whether you are renting somewhere, like you're still in a lease for a certain amount of time, you're gonna have to pay it or get a subletter. Like I get that you have to figure out if you're gonna move randomly and quickly. However, you do have more flexibility in a renting situation to just be able to leave, or if your work is unpredictable or something. And then to me, I like I want my clients to be responsible. So if you don't have any kind of emergency fund readiness, if your job is questionable here in the future, I think it's really smart to be assessing that, so that you're not acquiring something and then having a huge life change occur. This last one is a little cheeky. If your landlord is your BFF, if you love having somebody that you can just call and be like, look, this is broken and you need to fix it, and hands off, deal with it, figure it out, then, owning your own place maybe isn't the best option, because you're the person you're calling. You don't have that landlord to rely on. So obviously pros and cons there. That's great because you can just take care of it, but also you're more on your own. So another part to consider. Emma, over to you on renting versus owning.
Okay. And then I'll just touch on so our debate with the flexibility with home ownership. So I feel that home ownership gives you flexibility. So I own a place I've owned for a long time, and I have moved out of my place. I've rented it out. I've traveled. I've also renovated my place, so it was like a brand new place. So in my eyes, I feel like it's flexible, but I do see both sides of it, right? It's giving me opportunities because it's given me equity, and I've been able to use that for other things. So that's where our back and forth was on that one. So the rent versus owning, can you see this okay? Can everyone see it okay? It's a little small.
Yep, you're good, Emma. Thank you.
Okay. So a few things that I'm going to go over here, and it's explain some keywords. Now, you may already have an understanding of this, and maybe you do not, right? So what are the benefits of owning versus renting? Well, one of them that you hear is equity. Like, what is equity? Okay, so equity you generate in two ways. One is by appreciation. So that is the value of your home increasing over time. Depreciating, it goes down. For the most part, homes have appreciated over the last like 30 years. There was a few years, of course, in 08, 09, when properties went down, and then they bounced back. So there has been a few glitches in this, but over the most part, properties do appreciate. So from one year to the other. So for 2020, from 2019 to 2021, we saw massive appreciation. Over the last few years, last year and this year, it's probably been about maybe 5% appreciation. And some areas have more, some areas have less, right? So when you have equity in your property, that's gained from appreciation, but it's also gained from paying your principal. So principal is paying down your loan. So in the first one, we have rent in the first column, and this is done over a 4-year period. I have used a 2% appreciation in this, which is pretty conservative, right? So in the first 4 years, the total you'll pay in your rental is $148,000. If you were to purchase a place for $400,000 and you put 10% down, that's one option. The next column then is $450 with 10% down. You'll see that it may cost you more. Your total payments may be more, but you're getting more in return. That's the whole idea with buying a home. So you can see there you have your principal, you have your tax benefits. So you can write off interest that you pay in the year, and then you can also write off your property taxes up to $10,000. So that is a tax deduction. So at the end of the year or the start of the year when you do your taxes, you have a form at 1098, it's called. It will list how much you've paid, and you put that into your taxes. So that is a huge benefit. It's based on whatever tax bracket you're in. In this, we use a 22% tax bracket. So then that shows you your net cost, right? So you're going to compare that to your purchase or to your rent. And then we come down and then you have your equity, right? So your appreciation then is going to be included. So over 4 years, you would have 90,000. And the next one is 101. That's at a 450 just because of more appreciation. You pay down more in principal. versus renting at the end of your 4 years. You had a place to live. Thank you very much. So that is the benefits that we have there outlined. If you want to go over to the next one, this is going to show monthly payments. So the first one with rent. So if you're renting a place and it's worth purchase price around $400 to $450, the rent is probably going to come in at around a $3,000 a month, maybe $2,800. So this one here, we use the 6.625. Rates are trending down. It's kind of stopped. We went down. We were up in the 7s. We're down into the 6s. It varies what rent or what interest rate people are going to get, and it depends on the loan program. So I've seen anywhere from 5.75 right now to people getting a 7.25. Okay, and then there's lots in between. It depends on credit scores, down payment, property type, what you're using your home for as an investment, second home, things like that. Primary, are you a first-time buyer? Are you not? Are you using, first-time home buyer programs? All of those change your interest rate. We just put in a 6.625 when I put this together. So the payment here is $3,388. That is a total payment. So that's including taxes, HOA dues, if you're buying in a condo, mortgage insurance, and then home insurance. Okay. So mortgage insurance, that is something you pay if you do less than 20% down. Now there is a loan program where you pay PMI no matter what. So with an FHA loan program, which is a government loan, you have to pay mortgage insurance for the life of the loan unless you put down 10% or more. Okay, so with that loan program, the mortgage insurance is going to be calculated differently than with a conforming loan, which is Fannie Mae and Freddie Mac. So with those loan programs, your mortgage insurance is going to drop off when you get to 20%. And the amount that you pay is dictated, it's very tiered. It's based on your debt to income ratio, which is a calculation that we put together, your credit score, your down payment. All of those are taken into consideration when the premium is worked up. So it's going to differ from person to person. And once you get to 20%, now mortgage insurance is quite inexpensive compared to what it used to be. The premiums on it have dropped huge amounts over the last 6 years. So it's not a big ticket item when it comes to purchasing a home. So if we compare the two payments, go back. Nice. Like back. So now the payment to the rent, the payment in this one is a little bit higher, but you're getting something in return for it, right? You have your tax write-offs. This is calculated at a monthly amount. And then you have your principal that you're paying. That principal is going to change each month. So every month that you pay down your loan, the next month then you pay a little bit more principal and a little bit less interest. And that goes on. The more that you pay down, the less interest you pay and the more principal you pay. So with a 30-year fixed loan, your payment always remains the same, but inside of it, it's going to adjust. As the loan gets paid down, less interest is paid and more principal is paid. So that amount changes. So as time goes on, it makes home ownership more beneficial than renting once you get deeper into the years. And so then you have your net monthly payment there. That's just showing you if you take out the principal and the tax benefits, that's your net payment, not taken into account appreciation, which you'd also get. Does anyone have questions on this slide?
I was just thinking about now, are all of the fees and interest amounts, are they deductible up to that $10,000 that you mentioned?
No, mortgage interest is deductible, and property taxes. There's a tiny bit of mortgage insurance. I don't know if you can still deduct it. You used to be able to, but you need to be, your income needs to be under a certain amount.
Oh,
But you can't, if you have an investment property, you can write off all of your expenses against the rental income that's generated. But on a primary home, you can write off interest and property taxes.
okay, and it has to accumulate up to $10,000?
No, it's just your property taxes. You can only write off up to 10,000.
Up to 10,000.
Yeah. So
Yeah,
if your property has $15,000 a year,
you can
in
only,
property
they'll only give you
taxes,
up to 10,000 as an
10,000 and
exemption.
not the full 15,000. I see.
correct.
Right, exactly.
Okay.
Anybody else? Renting versus owning?
No, this slide was really helpful.
Yeah,
Thank you.
super helpful.
Thank you, Emma.
Yeah, of course.
Very
And I can put
digestible
this
format.
together for any, obviously any purchase prices. I have, a lot of clients that come to me and want to figure out if renting or buying, is going to be a good idea. And I always say the numbers speak for themselves, right? Like, let's look at how long you plan to stay on your home. Let's look at how much the costs are to buy and sell and see what the bottom line number is at the end of the day, right? And then you'll know if it's going to be a good idea for you or not.
Well,
Right.
and one
Thank
thing,
you.
one thing I wanted to mention too about moving into this next part about benefits of home ownership. I think this is a really interesting stat, a study by the National Association of Realtors in 2023, so pretty recently. They showed that the net worth of homeowners averages to be 40 times more than renters. So when you're looking at net worth of an individual or a couple or family or whatever, 40 times more, and a lot of that is because of this equity buildup over time, and we really haven't even touched much about appreciation. But when you start considering the rate in which rents are rising, the rate of appreciation, and the rate of inflation, all these things contribute to like what your net worth is in total. And so being able to, since you have to live somewhere, being able to see an increase in that net worth by owning the place instead of renting it, I think that's huge. So in talking about the benefits, going back to younger Keith that didn't really care about this, talking to him now, I know he was wanting to make more money, but I don't think he was thinking about it in terms of like broadly building his wealth and thinking about family and generational wealth, all those cool things. So with I mean, all of this basically is what Emma was talking about. You're paying rent now, but that's only paying off your landlord's equity. So if you want to be building the equity for yourself as you pay down that principal, then owning accomplishes that. The potential appreciation over time. We say potential to cover your ass, but really, I mean, like Emma said, except for 2008 when we hit a major recession, homes appreciate in value. A huge part of this, I think, that Emma and I talk about all the time is pride of ownership. You know, it feels different to be able to own a place and to care about it, and that translates also to control over your space and improvements. You know, you don't have to worry about renter-friendly improvements that you want to do. It's up to you, and you can make it your own, and you can feel good about that.
Yeah,
Huge
Keith,
part.
I think that a big part for me and Emma, my Emma, sorry, Emma, other Emma.
Other Emma.
Yeah, is like what you said, the pride of ownership and the control over space. It's like we have a lot of friends where we hear stories about the owners want to sell the building, so they've got 30 days to find somewhere new to live. That kind of unpredictability. In light of all the other things going on in the world, some kind of predictability and ownership is an exciting prospect.
Mm-hmm.
Yep. Yeah, and thank you for including that. And I think a lot of the people that I work with, you know, care about their community and they want to contribute. And I mean, this just lets you, you know, the term of planting roots really does apply here because you're starting to pay toward that school down the street. Those property taxes go toward that. And I think, you know, when you're going to meetings and community events, when you're speaking as a property owner within this district, I think it carries a different weight to the older people and to the people that you're talking to. So I think it's very, very powerful. Not to mention just the predictable payments. So what Emma was showing in this other slide, you're paying down the principal more and more as you go through this loan. However, your monthly payments are going to be the same. So we've all felt as renters that painful increase over time, and this is one way to keep it locked in. And then Emma talked a little bit about possible tax advantages as well. So Emma and I want to talk a little bit about common myths. Maybe these are questions that you already have written down, and then some frequently asked questions as well.
I thought this would be a good way to kind of bring up like the different down payment options and things like that instead of just like going through a matrix. So myth one, you need to be rich to purchase a home in Chicago. So the reality is they are doing their very best to make homes more affordable as far as mortgages go, right? We can't really control the price of homes, and they have gone up and up a lot. But they try to bring out loan options where you don't need a huge amount of money in order to purchase a home, right? So you can purchase homes as a first-time home buyer on a regular condo or single family home. You can buy with 3% down. You're not penalized on your interest rate at all for doing a 3% down loan. At times, actually, your rate is better than doing a 20% down, which a lot of people don't even know that. You can buy multi-unit properties. So you can buy a 2-unit or a 3-unit property, and you can do 5% or 3.5% down, depending on the loan program. And then you can rent out the other units and you can have money coming in. So you don't have to be a millionaire to purchase a home in Chicago. There's a lot of options for lower down payments, which people use all the time. And mortgage insurance does not skyrocket. So you'd be quite surprised. I'll have people come to me and they're like, well, we need to save up money. We don't want to pay PMI. And then I show them the cost, and they're like, oh my gosh, can't believe it's only $40 a month. So it does make things a lot more affordable to be able to purchase a home. Next one. What credit score do you need? Okay, so that is going to be, there's no black and white. There's one number for one program, right? So FHA, you need a 580 minimum, but that doesn't guarantee that you can get an approval. Okay. But at a minimum, you need it to try, you need to have a 580. You might have to compensate with either showing that you have more money in reserves, showing that you have a low debt to income ratio, or some sort of compensating factor in order to have the lowest credit score. For conforming loans, that would be Fannie Mae and Freddie Mac. The cutoff is 620. So if you're below that, you can't try. If you've got a 620, you can try, but there's no guarantee you can get qualified with a 3% down and do a 620. Again, you need some compensating factors, or maybe I've seen it work where you add someone that does have a higher credit score. But a lot of the times people come to me, if it doesn't work, we put them on a plan to help, improve their credit score. And if they stay at it and they stick to the plan, then we're able to make it work in, maybe 6 months or a year, depending on how long it's going to take. Sometimes it just requires some paying down of credit cards, maybe getting a collection removed that you didn't know that was on there, and your credit can be fixed. Other times it might take longer to do. And it might require a credit advisor to step on in and help us with getting things cleaned off your credit. And if we put you on a plan and my credit advisor says they can do it, they will get it done. I've had 3 clients this year that when they came to me, they weren't able to buy, and they stuck to the plan and they closed on their homes later on this year. And I was so proud of them, because there's not a lot of people that actually stick to the plan. But if you want something,
I think what's important about this is the fact that that Emma and I are here as resources for wherever you're starting, instead of thinking like you need to have all of your ducks in a row and everything figured out before you even start this conversation. Like Emma said, 3 just in the last year that she was able to start a conversation. We know people that can help you with credit if that's an issue, and be able to guide you in the right direction to be able to make this a reality. It's not something that you just are alone and having to deal with
Right.
yourself.
We had a client last year came to us and his credit was low and needed some work, and he's under contract now. And he stuck it out, you know.
Yeah.
he did it, and we're so excited for him.
Yeah.
So myth number 2. Okay, this is a big one I see all the times. A lot of people think they can't qualify if they have student loans, right? So I had a client who came to me, and she had almost $1 million in student loans. I am not joking. I was even like, whoa, that's a lot of student loans. So there's different requirements for student loans. Okay. You can either qualify with the payment that is listed there if you have a payment established, right? If you have an income-based repayment plan set up, which this individual did, and her repayment plan was something like $100, it would never be paid off, of course, but anyway. So all we had to include for her to qualify was that $100 payment. Now, there are other rules too. If there is no payment listed and your student loans are deferred, you have to hit with a 0.5% payment. So if that was her situation, she would not have qualified. But because we can do the income-based repayment plans, that is the way we went for her, and she was able to purchase a home. So just because you have student loans, it doesn't mean that you can't get qualified. You might have to change the way your payments are set up. But you can definitely, I think nearly, not almost, I would say 80% of people, maybe 70, have student loans, some sort of student loans on their credit report.
Absolutely.
Yeah. And then I wouldn't, people ask me too, should I wait to pay down my student loans? My advice on that is normally I wouldn't advise people to pay down student loans before they purchase a home, because homes are going to continue to increase in price. So by the time you have them paid down, you're going to be paying much more. And your student loans are normally a low interest rate. So it's something that you could tackle paying off later. And you never know, you might have enough appreciation in your home after 5 years to help you pay down your student loans.
Yeah. Question number 2, do I need a buyer's agent? So the short answer is no, you don't need a buyer's agent, which might surprise you. But especially if it is your first time, I would not advise to try to figure it out on your own. For most people, this is the largest sum of money that they put towards something. And if you're trying to just wing it and follow YouTube and Reddit articles about it, it's probably going to be pretty tricky. So, but if you followed any of the news over the last couple of years, you might have heard about changes within real estate and how representation works, which we can talk more about later. What I find is usually the main question comes down to, do I have to pay for a buyer's agent? Do I have to pay for one if I'm going to use one? And the answer today is still no, the vast majority of the time. Okay, maybe I myself have not had this happen. I'm sure there are examples where the buyer had to pay, but the way that real estate has worked for 100 years is that the seller pays the buyer's agent their commission, and even with all the news stories about this, that's still how it's happening the vast majority of the time. So there's really not a great reason to not use a buyer's agent, when ultimately it can save you a lot of time and frequently a lot of money, to utilize one.
Hey Keith, and Emma, quick question. Emma, you were talking about using the appreciation of your home value, potentially to pay towards student loans, and that's just an example. But how does one kind of tap into that appreciation? When I think of that, I think of you sell your home for a larger amount than what you bought it for. But if you're
Right.
keeping your home, how do you tap into that, or what are the ways you can capitalize on
Yeah, that's a great question. So if you don't want to sell your home and you want to tap into it, there's two ways you can go about doing it. One is you can add a line of credit to your home. It's a second mortgage to tap in. And a lot of people right now would be doing that if they have a really low interest rate and they don't want to change their first mortgage rate, right? So you can get a line of credit. I always suggest to people, if the best time to get a line of credit is when you don't need one, if you have a lot of equity in your home. So it's kind of just, it's like it sounds, it's a line of credit that taps into the equity in your home up to a fixed amount. You can draw on it and then you can pay it back. It's like a credit card that's available. People have used it to purchase second homes. They've used it to pay down credit cards, do home improvements. I've used it to do home improvements on. The other way you can do it is you can do what's called a cash out refinance. So if you have a mortgage on your home, just say you have a mortgage, you have a loan balance of 200,000 and your property is worth 400,000. So you have 200,000 in equity and you want to get, $75,000 out. You can do a refinance. So you can change your interest rate. So if your rate, a lot of people right now, I've got quite a few clients that were in the 7s and they are changing their rates now into the 6s, but they also have an option to do cash out too if they want. So I do have some clients that are pulling some of that equity out of their home. There is a specific cash out refinance that is just for student loans. So normally when you do a cash out refinance, your interest rate is maybe like an eighth or a quarter, can be an eighth or a quarter higher than the current rate. But for the student loan refinance, they don't charge you a higher interest rate. So you can take it out, pay off your student loans.
Yep.
Got it. Thank you.
All right,
Okay, myth 4, we hear this like all the time. People are going to wait for rates to go back to the 3%. That will be a really difficult one to sit and wait for. Okay, so as I said, I've been in the business since 05. I've seen rates low, 2 or 3 times. The lowest was the 3% and below, which was only once, so we might have to wait for another pandemic. I would be extremely difficult for rates to go down that low with our current inflation. It would be a disaster.
Well, and it's a global catastrophe that was the result of that.
Yeah.
So
if you're going to
really
wait,
want that to happen.
Yeah, we don't want it to happen, and it caused a huge amount of inflation. So waiting for rates to go down you'll lose out on the current market prices and end up purchasing a property.
I think it's helpful to state too that the 50-year average for mortgage rates is like 7.5% ish in the 7s. So being able to think, talk to your parents. A lot of you are my age. Like in the 80s and 90s, it was like 16%. So I think that's helpful to remember. In our recent memory, 3% is, that seems like that's what it should be, but historically it's closer to where it is now.
Exactly. Next one, you don't need 20% down. If you don't have 20% down, you'll pay a fortune in PMI. So that's something I've touched on already. So the reason why mortgage insurance has gone down so much, there is a reason to this. When everything else has increased, it's because there's not nobody, but the default rate on mortgages is extremely low. It's like 3 to 4%. So mortgage insurance and insurance premiums rise when people are putting claims in. That's why our homeowners insurance has gone up so much. So many disasters going on around the world. But with mortgage insurance, there's hardly any claims put in. So the mortgage insurance companies are really happy and they've dropped the premiums a huge amount, which makes it very affordable to do lower down payment options. Myth 6, I need to pay off all of my debt before I will buy a home. That is not true. So when we're qualifying somebody on a home purchase, we look at what are your monthly payments, right? We don't look at how much debt you have as a whole. It's based on monthly payments. So it might be necessary to pay down a little bit to purchase where you want to purchase in the price range you want to purchase in, or it may not. So that's something that we would look over to see how do you qualify with the current debt that you have? If you need to pay some of it down, then we can set it up that way, but a lot of the times people don't need to. The last one here for me is you can't buy a home if you're self-employed. That's wrong. You can if you're self-employed. Is there anyone here that is self-employed? Anybody? No? No one?
No, not here.
All right. Okay, well, if you know of anyone that's self-employed, let them know that they can still buy a home.
Still buy a home.
But the reason why this comes up is because a lot of self-employed they can write off their income against expenses. So they tend to write off a lot of expenses, and so they don't have to pay a lot of taxes. If we're doing a mortgage and we're going traditional, you have to go off and watch the gross amount is, sorry, the net amount is. So if you write everything off and you're left with, $200, then that's all you got is $200 in income. And there's a lot of other loan programs we can utilize that don't use tax returns.
Let's talk about waiting versus.
Okay. Yes, this is a great one. Okay. There is something called the cost of waiting, which some of it I have described a little bit earlier on, people waiting for rates to come down, prices to come down, the market to crash. We've heard of all of this, more inventory, and to save more money or to pay off debt. So while you are waiting, you're missing out on appreciation, right? You're missing out on tax advantages that you could have, and property values are increasing. So this was showing if somebody was waiting for 2 years, the increase that they would pay. So the appreciation gain, this was based on the historical. So they were missing out on almost 8% appreciation. And then also the payment difference between the rent versus the own. So in this particular situation, this scenario, it was $37,000 more expensive, or what was missed out on if you wait 2 years to purchase a home. So just keep that in mind. It's a thing.
Yeah, and then what that means monthly too is huge, right?
Yeah, exactly. So, I've had clients waiting, since 2022, 23, 24, and now values have kept on going up. I look at it myself. So if you're looking at, I should wait until I have one thing paid down, you need to look at the big picture as well.
Yeah. Perfect. Thank you, Emma. So we're getting close to the end here. I appreciate everybody's attention. I want to leave time also for any questions that come up. The basics of how I can help you and what we would be doing in the next steps is we would sit down and kind of talk through your goals and align with that, have a strategy session about must-haves, where you're looking, and the timing. And then I help streamline the rest of the process. So curating the listings that are getting sent to you, coordinating tours to be efficient with your time, and then being a steady hand throughout it. It can get emotional. That's normal. It's a lot of money, and it's where you live, and it's lots of uncertainty. So I'm a steady hand throughout that, and offering guidance through the negotiation and getting you with credible vendors, including your home inspector, those types of things. Just checking in with you, making sure that you're understanding where we're at. Education is huge for me. So being able to make sure you understand what's going on and why, and that you're prepared for whatever the next steps are. Okay, so with that, I do have a little PDF booklet that you guys can get from this QR code here. I'll also send it out to you about getting ready to buy. This is all of our information if you don't have it already. And I really just want to make sure everybody has time for some questions or thoughts.
Yeah, I don't think we have any specific questions left. Kind of asked them throughout, but I really appreciate Emma and Keith, you taking the time to put this together.
Very eye-opening for both of us, I think.
Yeah, we've never really been the people that thought we could own a home. We've always thought, renting is the safe way to go. It's predictable, but also it's unpredictable. And the thought of owning a home is really exciting and seems more accessible than ever.
Yeah.
And we really appreciate you taking the time to put these things together. And for hosting this tonight.
Yeah, this is super helpful. Thank you guys.
Thank you so much.
Yeah,
Thank
you
you.
guys for your questions too. Yeah, and I think it's what I like about this, and again going back to younger Keith, I think what I really couldn't have seen then was that just how this can connect you further down the line. If it's a real stretch to get that first starter condo here in Chicago, I still think it can be truly beneficial for you and your family because you're able to start building that equity. You're starting to see that appreciation, and then it makes it so much easier to make that next purchase that's maybe a better fit than that first one was. So being able to think of things as steps too, I think there's a lot of pressure of kind of it being your forever home right away, and really it doesn't have to be. I think it makes a lot of sense to start with where you're at. So yeah, I think that's a huge benefit as well.
Yeah, that's a really good point. We find ourselves a lot of times in the rental places that we've had itching to make improvements or to do modifications, but at the end of the day, when you move out, and you've got really nothing to show for it. And so, yeah, the thought of owning a place and seeing some appreciation or just some gains from making those improvements is exciting.
Yeah.
Oh, one of the things that I didn't mention, it's a first-time homebuyer programs and down payment assistance. So most of the first-time homebuyer programs and the down payment assistance they're available, but there is an income limit on it. So if you make over a certain amount of money, you get disqualified for it. There's a lot of different programs that come out throughout the year as far as these grant programs go. So once they run out of funds, then they get shut off. Earlier on this year, we did have a Cook County grant program that was available. It was up to, is it 20 or 25,000? It was up to 5% of the purchase price you could get as a grant that was forgiven in 5 years. Then also Illinois Housing Department, they have a down payment assistance that they offer throughout the year. They'll add one in every once in a while, but they have standard ones that they offer. So there's different programs like that as well to cover closing costs. And Keith can also help negotiate a seller credit too to cover some closing costs as well. If that's something that's worked into the contract to help with some of that funds.
Yeah.
That's
really,
great. Thank you.
And what I want you guys to leave with also is just that whether this is something you're considering now or further down the road, like we're here as resource to resources. If you some people I talk to are like, I really just need to talk to like a financial planner and I don't have my books in order and I need an accountant to be able to help me with this. Em and I talk to so many people all the time, every single day. And so if you need an accountant, financial planner, even personal trainer, we have people that we talk to all the time. And so we want you to be able to reach out to us because we are not in this business because just because of every time a transaction happens. Like, we like being able to connect people, and that's what's really fun for us is connecting. So I hope that if anything, leaving this, you don't feel alone in trying to figure this stuff out. You can always reach out to us, whether that's booking a consult, looking to get pre-approved like now, or just questions about properties, how this stuff works. We're always happy to answer those questions. I wanted to make sure Brett, Lyra, Alexa, Alex, anybody else might have any questions or things that you wanted to ask.
I guess just wanted to, yeah, echo the thank you for putting this together. This was super helpful and makes it feel a lot more accessible. So I'll definitely be reaching out to figure out some next steps. It's also like off the jump, it was kind of maddening seeing like the amount of rent I see and then like the type of home that I could be buying.
I know, right?
But it's a good thing. It's a good thing. So thank you for that.
Yeah, you bet.
Yeah, no questions from me, Keith, but all great information, and I appreciate you guys putting this together.
Cool. Yeah, I appreciate you guys being here. Thank you for your time. We'll let you get on with the rest of your evening, but please reach out if you need anything, and thanks again.